and welcome to Market Wrap, a weekly update on equity markets and outlook for next week with Mr. Pankaj Pandey, Head Research, Icicidirect. Very good afternoon, Pankaj, and thank you for joining us.
Hi, good afternoon, Geeta.
Markets remained volatile through the week, Pankaj. Recovery remained very short-lived and Nifty closing below 17,000 for the week, losing nearly 80 basis points, percentage point this week. Broader markets collapsing, taking a deeper cut. Uh, what next? How much more pain? Because whatever recovery that we see in the markets is being sold off.
So I think a number of things, Gitu. One is I think we have the Fed meeting this week. So largely the biggest anxiety sort of behind us.
Mhm.
But so that is one of the anxieties which have been sort of put to rest. So with Fed hiking by 25 bips, largely now it is clear that bulk of the rate hikes are sort of behind us. At
Mhm.
best, you will see about 25 bips hike. I think the one positive aspect of this banking crisis has been that Fed has sort of given it a stance on quantitative tightening. So, in fact, last 2 weeks they have pumped in about $400 billion. Now, the
Mhm.
challenge is that while we have issues with US banks that is causing volatility, now there are challenges cropping up, especially for related to foreign banks like Deutsche Bank.
Mhm.
Now, there the credit default swaps have sort of gone up, so that is sort of leading to volatility. And our sense is that till the time these elevated interest rates remain, markets could continue to remain sort of volatile. While central banks might support, but I think the challenge is that we have been in a sort of a listless market for quite some time, and largely, I think if some of these issues further crop up, then I don't see much of a respite for the market. So I think the best possible scenario could be a consolidation in the range of 16,800 to 17,200 kind of a levels.
Mhm. Mhm. Pankaj, as far as the next week, coming week is concerned, we have expiry, derivative expiry, monthly expiry, and then uh, we have a truncated week also. Uh, and above this, we have FIIs sitting on a huge short position in on the derivative side. So, what can be expected?
So one is, so for example, till the time 17,000 levels are not held by the market, one should not be very positive on the market given the overall heightened volatility. And like you
Mhm.
said, it's a sort of a truncated week, so we are expecting more of a stock specific move to sort of pan out.
Mhm.
But there's some positives as well, which has sort of come out is that one, the commodity prices have declined. So obviously that also helps us from managing inflation.
Mhm.
But overall, there are no major triggers for the market to sort of do better or unless all these sort of negative news sort of subside.
Mhm.
So from that perspective, I think we would expect more of a short, what do you call, a stock specific move rather than sort of Nifty doing anything. Outlook for next week is volatile as well.
Pankaj, we have been doing this program for quite a long time now, and it is for the first time that I'm seeing some kind of a concern on from your side as far as the markets are concerned. There's no optimism that we used to see a few weeks back. But that's market. That's the beauty of market. You have ups and downs that you have to play out.
So I can qualify that. So for example, see the challenge is that while US markets we have seen a sharper increase in interest rate, but the challenge with European market is that they have seen lower interest rates for a longer period of time, and if challenges are cropping up with another big bang there, then
Mhm.
I think largely it is the global-led volatility which is sort of impacting markets. I think domestic fundamentals continue to remain intact, which is why we have been sort of maintaining Nifty target levels. But
Mhm.
very difficult to take a call on how or by when this global volatility is going to subside. And which is why things are a bit worrisome, especially on the global side and the consequent impact what we will see in our markets.
In that case, would it be proper to really focus on the domestic stories?
Well, absolutely. I think when you sort of look at from a sectoral perspective, defensives have relatively done well. So it does not really make sense to sort of look at sectors which are heavily oriented towards global macros. I mean, be it metals, be it IT to some extent. or textile or a number of other sectors. So from that perspective, the domestic segment are sort of looking a lot more better, where you would not see this kind of a volatility seeping in because of global cues.
Let's talk about the extension numbers. How were the numbers on face of it? Though they have met the expectation, the street expectation, but they have also cut on the jobs. How does that reflect on this the numbers that they have given?
So I think the good way to read it is that when you sort of look at business segments, Accenture has two business segments. One is outsourcing, which is a proxy for Indian IT companies, and the other one is consulting, which most of the Indian companies don't do because
Mm-hmm.
consulting is a slightly high-end job. Our
Mm-hmm.
challenge is that the consulting as a business is not seeing growth, and the outsourcing as a business has seen about 16% YY growth.
Wow.
And when you sort of even look at the new bookings have actually gone up by 31% on the outsourcing side. So, which is a very positive news for Indian IT companies,
Okay.
because whatever fears people have in terms of global economy is not doing well, and that having an impact, especially on some of the key verticals like BFSI. I
Mm-hmm.
think this company is clearly sort of defying that. So in a way, this is a positive rub-off for most of the Indian outsourcing companies.
Okay.
And since the order bookings or new bookings have been good, these revenues will translate into next year in terms of a better set of numbers next year and then year after. So I think overall Accenture numbers are good. Whatever layoffs you are seeing are more on the sort of a consulting side, and
Okay.
which is where I think Indian IT companies don't have a role to play. And also because of the fact that, see, consulting is largely required more of transformation journeys what companies take. Indian
Right.
IT companies are largely focused more on cost cutting and efficiency parameters being improved. So from that perspective, Accenture is numbers are good news for IT companies.
So, which are the companies that you're betting on in the IT space right now?
So it is better to stick with tier one names like TCS, where we have a target price of 37.80, and Infosys with a target price of 730.
Okay, let's talk about the FMCG space, the only sector which closed in green as far as the entire week is concerned. And we saw good momentum in some of those stocks. But now we have fear of increasing competition from Reliance entering into the FMCG business. How do you see the transition happening? And how do you see this panning out for the entire FMCG space?
So Reliance was there in FMCG business, but they were largely there in the modern trade format. Now they are venturing into general trade. And whatever pricing you see for some of the categories like soaps, I mean, they are discounting by nearly 35 to 50 odd percent. And that's a
Mhm.
sort of a significant discount. Now, our challenge is that whenever a new player enters, there are two, three possibilities which happen. One, you see a contraction in margins, or the margins will not go up. So, for example, HUL in the last decade has seen a margin improvement of about 800 bips. And the other thing is that if your margins get contracted or are not likely to sort of go up, it would have implications for growth. It would have implications for PE multiples. And most of these stocks are trading at 50 to 60 kind of a forward multiple. So our sense is that if not price correction, at least these stocks are structurally headed for a time correction. And
Okay.
from that perspective, I think while they would have sort of done very well in terms of price in the last decade, but I'll not be very hopeful of a repeat performance in the next decade. So, which is why we have a hold rating on most of the counters. HUL, Jyoti Laboratories are both hold according to us. As and
Mhm.
when the development takes place, I think this is one space which needs to be watched for, because Reliance is not a small player. Historically, we have not seen any new player gaining significant market share. But
Mhm.
like what we have seen in case of paints, probably a repeat of that is expected in FMCG as well.
Weather is also turning volatile. In Delhi, the temperatures have dropped drastically. We have a very pleasant weather in Delhi, but it is expected that summers could be as harsh because of the El Nino impact, and monsoon will be deficit this time. This is the time to really get into some space which can, offer some kind of a cushion to your portfolio, the power sector. How do you see the power sector as far as getting good quality names to fit in your portfolio?
So I think power, largely what is expected is that the demand this year is going to be higher. So demand is expected to be about 230 gigawatts compared to about 200 gigawatts last year. Now,
Mm-hmm.
there are some structural challenges because last 4 5 years we have added more of solar capacity and less of thermal capacity. Now,
Right.
typically solar works well during the daytime, but during night, our sense is that we have not added sufficient amount of capacity on the thermal side,
Mm-hmm.
and which is why there are concerns that we might might sort of a power crisis this particular summer during
Mm-hmm.
peak times. Now, there are
Mm-hmm.
some measures the government has taken. So one obviously is that they are allowing all the imported coal-based power plants to sort of work or import coal so that they operate at optimum capacity. They have directed NTPC to sort of run their gas plants. And also, from that perspective, they have allowed Indian Energy Exchange to sort of launch a day-ahead market with a tariff of about 50 rupees per unit. So government has obviously taken some measures, but one name which, according to us, will clearly benefit out from this is the largest thermal power player, which is NTPC. I think here two, three things can turn positive. One is the PLF for thermal power plants will go up. Then, along with that, incentive is something is what they can earn, and
Okay.
which is why we feel that this is one company which is looking good or should benefit from this event sort of unfolding with a target price of 207. The
Okay.
other is that IEX has been in a sort of a downtrend, but our sense is that probably this is slightly better news for company because the company will be able to sort of grow up their volume by 15% because now the rates have or they can launch products where power can be traded up to 50 rupees per unit. So from
Okay.
that perspective, NTPC clear beneficiary, IEX I think probably more of a reversal of trend is what we would see.
One of the words that we are hearing this time is fluorination chemistry. I don't exactly understand what this is. If you could please explain what exactly is this and what is the kind of impact it is going to have on the chemical sector.
So chemical is a vast sector, but what you see, or the maximum news flow or the maximum capex, which is sort of happening, is the fluorination chemistry. Now, to give you some perspective, fluorination has extra advantages. So, for example, when you use this fluorine chemistry in pharmaceutical, the efficacy or the potency of the product is a lot more better. So, which is why we are seeing whatever new pharma products which are sort of getting launched, there the contribution of this or the product usage is gone from 25 to 40 odd percent. For
Okay.
agrochemical also, this has gone up from 30 to 50 odd percent because
Mhm.
of the better efficacy and better potency. Now, besides this traditional segment, the fluorination is also finding increasing usage in number of other categories. So a lot of when you sort of look at user industry, so for example, in automobile or when you look at say cooking pans, since fluoropolymers offer good heat resistance, so which is why these products are used, and which is where the fluorine chemistry comes into picture. Similarly, for a lot of sunrise sectors, I mean, be it EV or be it hydrogen fuel cell or solar or 5G, there are products we use which eventually use the fluorine polymers. And then one of the traditional usage of fluorine has been on the refrigeration side. So whether it is AC, whether it is refrigerators, the gas which is used is has an element of fluorine in it. And what we have seen is that significant of capex being announced. So SRF has announced a capex of nearly 15,000 odd crores, 12,500 odd crores is largely for specialty chemicals plus fluorochemicals. Similarly, Navin Fluorine also has announced a capacity of about 40,000 odd tons. Then there are a number of other players who have announced. So what we are seeing is that the higher usage of fluorine in various segments and also the capex behind, and which is why we feel that within the entire chemical as a space, if there is one theme which is sort of standing out is that is the fluorine chemistry or fluorine theme. and which is why players like SRF or Naveen Fluorine, so these are the two which we cover. So I think these are the two companies which we like the most, and these are the stocks where probably one can look at from a portfolio perspective as well.
After insurance, now we have AMC industry, which is facing the brunt from the government amendment to finance bill, which now gets into the taxation for debt mutual funds. How do you see it auguring for the AMC industry?
So not a very good news for the entire AMC as a pack because I think what happens is that all your non-equity oriented funds, so be it debt funds, international fund or gold fund, now they'll not be eligible for any indexation benefit. So typically with indexation, the tax incidence for a customer used to come down to 7 to 10 odd percent. But without indexation, now it will be about 30%, the kind of a marginal tax rate which will be applicable. So they are as good as now FDs. Or they are made on par with FDs in terms of tax treatments. Now, the challenge is for some of the AMCs is that, of the overall AUM, about of 12 lakh crores, which is on the debt side, about 3.5 lakh crore is on the debt, which is of a longer tenure and which is what will get impacted. From AMC perspective, if you look at HDFC AMC has got about 12% of the AUM exposure toward these long-term funds or long tenure debt funds. Similarly, Nippon also has about 12-13 odd percent. I think Bandhan, which has recently acquired IDFC mutual fund, will be impacted the most at 37% of the overall exposure.
Okay.
So I think a lot of these targeted debt funds or maturity funds will get impacted. So not a very great news. I can't sugarcoat much also. So I think things are negative for AMC as a pack overall.
I wonder why can't we keep the policies for long term? I don't know why do we shift from one. It was insurance and now it's AMCs, and there was also news of STT being implemented on. I think the derivatives, which is now being clarified. What was that exactly?
So for option traders, so STT is applicable when you sort of write options. So for example, if you're buying say 10 lot of Nifty, value could be 1 lakh crore. So one lot is typically 10 lakh crore, 10 lakhs. So I think the STT is gone up from say 2,000 rupees to 2,400 odd rupees. So roughly an impact of about 2 points of Nifty overall. Now, largely for most of the retail customers, it is so they are typically not option sellers because the STT is applicable on selling of options. For option buyers, there is no impact. But yes, overall, we have seen the option turnover sort of jumping. I mean, when you look at of the overall market breakup,
Right.
99% is options only. So I think probably this might limit or this might sort of impact in terms of the kind of bumper growth what we are seeing in options. But again, it's a wait and watch kind of event as of now.
So a sentiment impact we already seen in the markets with Nifty closing below 17,000 marks. Let's now talk about the hidden gem, Pankaj. So which is the stock that you are giving as hidden gem this week?
So what we are liking is Mayur Unicoaters. Here our target price is 580. Now this company is into technical textile domain and largely manufactures artificial leather. So you would find their applications in the seats of most of the cars. And typically for them, domestic sales is about 80%, 20% is export. Besides cars, I mean, you see their usage in footwear, number of other segments. So footwear constitutes about 30% of their sales. So you have customers like Bata, Relaxo, Action among their customers. Automotive contributes about 55% of their top line. So you will have most of the players like Maruti, M&M, Volkswagen, MG, so all of them. Now, the good part is that they've been focusing on the export or OEMs who are sort of residing or who are sort of based outside India. typically the likes of Mercedes, BMW, and all of it. Now, that is one segment where the margin profile is good, and this is one segment where the company is talking about 2x or 3x kind of a growth over the next 2 years. And our sense is that this company is also a beneficiary of crude oil prices, while margins had improved in the recent quarters, but with further decline in crude oil prices. So again, that is another added positive. Now, management is guiding for a top line of about 1,000 odd crores in FY24 from 800 kind of a level, and further to about 1,100 to 1,200 odd crores in FY25. But we have largely taken a sort of a conservative view of it and taking a top line of about 1,000 crores by FY25. So that will still sort of deliver about 15% CAGR kind of a growth rate along with margin expansion. So our sense is that profit could grow at about 18 odd percent. Balance sheet wise, no major challenges because they're sitting on a cash surplus of about 150 odd crores. They did a buyback of about 40 odd crores, so no major challenges there. And I think its stock is trading at 89, so FY25. So we feel quite comfortable with the management commentary coming out. And which is why I feel that despite whatever volatility we see, whenever the volatility subsides, I think this stock should do well with a target price of 580.
So hidden gem is Mayur Uniquoters with a target price of 580. It's a 12-month target, not a short-term target at all. Pankaj, nobody knows what headlines would hit the wires until Monday's open. But based on the current situation, the current closing, how would you approach the markets for next week?
So one is I would expect more of a stock specific moves to sort of pan out, and then the thing is that we are looking at or you might see some bit of a result oriented activity because next month the results will start coming in. But I think global events, let's see how they sort of unfold over the next few days. I think that will have a bigger bearing on the market. And I think, like I said, if 17,000 levels are not withheld, then I don't think one should be turning very positive from a shorter term perspective. Otherwise, these are one of the very good levels for building building one's portfolio, because we have seen most of the stocks sort of cracking 10 to 15 odd percent, be it large cap, mid cap, or small cap. Since domestic macros are good, so structurally we are not negative on Indian markets. I think global volatility could take some time to sort of subside, and that time I think people need to have some patience. Market, you get periods of time where market patience or tape patience overall gets tested.
Thank you so much, Pankaj, for being with us and for sharing your views on the markets.
Thank you so much.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.